To set the stage and highlight salient facts about the current and future state of the economy is Rick Mattoon of the Federal Reserve Bank of Chicago, where he serves as Vice President and Regional Executive of the Detroit branch. Rick's primary research is on issues that face the Midwest region economy, so he's perfectly positioned to lead the day and will include highly topical issues such as supply chain and other economic challenges currently facing the region and the country. In addition to his role at the Fed, he serves on several councils and committees, and Rick is also a lecturer at the Kellogg School of Management at Northwestern University. Please join me in welcoming Rick Mattoon.
Having me address this important event. It's a real pleasure to be working with the Alliance for Regional Development again. I'm going to go ahead and share my screen and show you my presentation, which hopefully will have a number of interesting things for people in terms of where we think the economy is at this point. So here we go. So first thing I have to do is offer the standard disclaimer for anybody who has not seen a Fed presentation before, and that is the remarks I'm about to give are my own and not necessarily those of the Federal Reserve Bank of Chicago or the Federal Reserve System. So what do I want to do today? Well, the first is I want to lay down some basic themes for what are sort of shaping the outlook of how the economy is performing. The first theme really has been the speed of resilience that the economy has shown in the face of the COVID pandemic. And frankly, I think this caught most economists by surprise. The downturn was extremely sharp, almost record decline in terms of economic activity, but the recovery has been equally sharp. And I think many people were surprised at how quickly firms figured out ways to pivot to maintaining output. And the effect this has had is it's sort of like we went from sort of shutting down the economy overnight to trying to turn it back on overnight. And that's put a lot of stresses in sort of the way the economy is behaving right now. The other thing that is also a common theme has been like the downturn, the recovery has been extremely uneven in terms of its behavior. So specific communities, particularly low income and communities of color, and specific industries such as leisure and hospitality and restaurants, for example, continue to struggle, while other sectors of the economy really came through the pandemic in flying colors. They really showed very little sort of stress in terms of having a sort of decline in activity. This uneven and relatively sudden economic recovery, though, has triggered a lot of sort of intermediate and hopefully transitory problems. And this is showing up in things like pricing pressure, inflation spikes, and supply chain disruptions. The bottom line, however, is the way you have to think about the timing and the shape of the recovery is it's still very dependent on the path of COVID. So if we see, additional spikes in the sort of the way the pandemic is being handled, or sort of a third wave, so to speak, you're going to see the recovery is going to go into this sort of fits and starts pattern that we've already seen for some time. So a good place to start is really with the report that came out of the September Federal Open Market Committee meeting. And at that time, there were a couple of significant adjustments that were made to the forecast. So what this forecast represents is all the Federal Open Market Committee representatives, and it shows their median forecast for where they think the US economy is right now. As you can see, there's some significant changes. So if you look at the red outlined area, as you can see in June, the projection was for US GDP, this is real GDP, to grow at 7% for all of 2021. That's really breakout performance for the US economy, extraordinary levels of growth. As you can see, that was marked down to now 5.9%. And that reflects, again, these headways that we're seeing in the economy. So the economy is being affected by these supply chain problems, by these pricing increases. And it suggests that some of the growth that we saw in the first half of the year will tend to flatten slightly in the second half of the year. The only good news about this is you can see the FOMC participants expect this sort of growth pattern, however, to have legs to it. So as you can see in 2022, they're looking for 3.8% GDP growth and even 2.5 by 2023, well above the long run trend of 1.8%. So suggesting 3 years of sort of healthy economic growth for the US economy. Now, the flip side of this is, as you can see, is in the blue circled area, and that's the expectation for inflation. So in June, the expectation was for inflation to be running about 3.4% through 2021. And that's on the PCE indicator, which is the Fed's preferred indicator for looking at inflation. But as you can see, that was marked up significantly to 4.2%. And while it's expected this will be trimmed out in 2022, it's still running above the 2% longer run target of the Fed and continues into 2023. So the expectation is, again, a lot of this inflation we're seeing right now is transitory, but we'll still be running a little bit hotter in terms of inflation into 2022 and 2023. So let's take the big picture. Where are we right now, and sort of like what are the indicators of our current performance? So the first is GDP performance. As you can see, the good news here is by the second quarter of 2021, GDP had actually surpassed where it was pre-pandemic. So we've restored all of the lost in GDP activity that occurred during the pandemic. But as you can also see in these sort of lighter colored red bars going out, which are the forecast by the blue chip forecasters, is it really shows this sort of somewhat slower growth pattern going forward. So after first quarter growth of 6.3%, then second quarter growth of 6.7, as you can see, we're trending down into kind of the mid to low fives for the rest of the year. So again, a slightly slower pattern than we had seen originally. The other thing that's showing up is we're not all the way back in terms of sort of the pandemic to the sort of normal economic activity when you take a broader perspective than GDP. So this is an indicator that Moody's puts together with CNN Business. And what it does is it has a back to normal index, and it rates sort of how far back are we in terms of economic activity relative to the beginning of the pandemic. As you can see, for the US as a whole, we're about 91% way back. And most of this, lack of sort of getting to 100% gap, 100% back really has to do with the labor market. At this point, we still are about 5 million jobs below where we were pre-pandemic. There's still lots of stresses in the labor market we're seeing. And this is being reflected in the fact that we're not all the way back to where we were pre-pandemic. As you can see, only 2 states are 100% or more back, Idaho and South Dakota. And most of the states are in this sort of 90 to 99% range, with the exception of Illinois, as you can see in our region, which is really in the 80 to 89% range. The one theme that, again, I can't emphasize enough is that COVID continues to impact the economy. And most of the data I'm about to share with you really illustrates that. So you're going to see sort of when COVID cases spike, these sorts of particular indicators tend to respond to these sorts of conditions. In other cases, COVID was very instrumental in explaining sort of the behavior within a particular market, for example, real estate. So I'm going to look at the labor markets, I'm going to look at real estate, both housing and commercial. I'm going to look at personal savings, stock market performance, household wealth, and inflation. So first, let's turn to employment. The first thing you should notice, again, is this idea of an uneven recovery. So the green line, which is at the lowest level, are people with bachelor's degrees or higher. As you can see, their unemployment rate is significantly below sort of the headline number for unemployment in the United States, and has declined pretty sharply. You also should notice that the unemployment among bachelor's degree holders never peaked the way it did in other categories. So the uneven part is really looking at who's been affected by this pandemic, which are basically lower skilled workers. And that shows up in those with less than a high school degree or high school graduates with no college. As you can see, their unemployment rate numbers are still significantly higher and extremely elevated, as those are, again, areas where those jobs haven't fully been restored, particularly in things like leisure and hospitality and restaurants and then other things like that, where this particular skill set tends to be most heavily employed. So again, very uneven pattern as to who's sort of recovering at this point in terms of the labor market. Another thing that's of considerable concern to economists is the decline in the civilian labor force participation rate. So as you can see, coming out of the Great Recession, we saw this sort of gradual decline already occurring in the labor force participation. But what we saw was this sharp decline really that came during the pandemic. And then even coming out of the pandemic, what we've seen is this sort of flattening at a new sort of historically lower level. That's of concern because it's suggesting again, part of what we're seeing in terms of the difficulty of hiring people is there's just fewer people in the labor market right now. And the real question is, what could happen and what could we do potentially to lure these people back into the labor market and get this participation rate up to sort of more historical standards? Now, there's a number of theories, and I really would describe these almost as hypotheses that's explaining why unemployment dynamics seem to be different this time around. The first has to do with sort of the nature of this kind of flipping on the economy overnight. So if you think of restaurant workers, for example, essentially all restaurants went to either only takeout service, no table service for a long period of time, and they essentially furloughed almost all of their workers during this period of time. Then you think of what happened. So all of a sudden, COVID cases dropped. Places started to reopen on a fairly active basis. Everybody wanted to go back out to a restaurant. And for the restaurant industry, this meant you essentially had to hire your entire staff overnight. And everybody in the restaurant industry was competing for exactly the same workers. And so therefore it became very, very difficult for them to fill a lot of these positions. The other trend that's different this time around is we're seeing an acceleration in workers retiring. And this could be for a couple of reasons. One is, unlike the Great Recession, the stock market has been going up during this period of time. So people's 401ks, for the most part, look pretty good. And so a lot of older workers may be saying, maybe now is the time to sort of jump into retirement. I'm in pretty good shape in terms of my household balance sheet. Another thing we're seeing this time around is workers clearly seem to be gaining bargaining power, which they really haven't had for the last 2 decades. So this sort of new trend in terms of employees going on strike, all the other areas that we're seeing really demonstrate the sense that you're having bargaining power now among workers. Another key issue is a skills mismatch. Where workers are unemployed at this point, they simply can't necessarily match with where the jobs are open. So there's a massive shortage of truck drivers at this point. But you can't take an unemployed retail worker, for example, and put them behind the wheel of a truck tomorrow. And so therefore, there's again a lag in terms of where the jobs are with where the people who are unemployed are in terms of their skills. And another could be just lifestyle change. I mean, part of what you're looking at here is that some people may have decided that the cost of working was simply higher than they thought. Commuting, having childcare expenses, all of a sudden they realize that maybe they can make do with only one breadwinner in the house. And they've decided that, all of a sudden that maybe staying home makes more sense, at least for the midterm. So that's also a change in terms of dynamics. So let's turn to real estate. So on the home sales side, this has been sort of categorically strengthened the economy. One of the things you saw was people again moving into wanting larger homes and larger spaces when all work sort of pivoted to being from home. So lots of suburban housing markets became very popular. There was a lot of sort of upsizing in terms of the way people were looking for, and existing home sales really exploded. As you can see, the unusual pattern was they were particularly strong through the winter months of last year, which normally is sort of a time in which home sales tend to sort of fall off. And they've stayed at sort of very high levels, sort of at the high end of kind of the historic bound for what we've seen in terms of home sale. But what's held them back actually has just been this, which is a lack of inventory. During this period of time, there wasn't a lot of new housing built. Existing homes that were on the market were quickly gobbled up. And in many places you had, very sparse inventory. So for people looking to buy homes, it was an extremely difficult situation. So not surprisingly, when you put together the combination of super high demand and low inventory, you get surges in prices. And as this Case-Shiller index will show, house prices have really exploded um, throughout this period of time. and continue to sort of rise at extremely high levels. And this is again sort of putting a crimp in some of the demand that people might be willing to, sort of undertake in terms of looking for housing at this point. The flip side of this really has been commercial real estate, and this is really an evolving story. So when you look at the commercial real estate market, what you have to realize is there was sort of a modest bounce back when reopening occurred, but there's still a huge number of uncertainties as to what the ultimate demand is going to be, particularly for office space going forward. So if you think of office space at this point, there's a sense in which, some companies have announced that they don't plan to return to the office at all. They're going to go to a virtual platform really for almost all their workers. Others have gone to a hybrid approach where workers will be back in the office, but on a more limited schedule. And all this is suggesting that office floor plates will probably shrink. You're going to have to repurpose office for a much more flexible workforce that's going to be coming in only on occasion. And so that's going to change some of the dynamic for what office is going to be demanded and where it's going to be demanded. You also may have interest in people opening up satellite offices in suburban areas, which could be cheaper to operate. And all this suggests that there's going to be a new equilibrium when it comes to demand for commercial real estate, but it's going to be hard to figure out exactly what that new equilibrium is going to look like, at least for the next year. Similarly, there's some indication that retail is going to go through some issues. We're over retailed coming into this particular episode, and what you're going to see now is have people adopted to doing more online shopping, maybe brick and mortar store demand down significantly or permanently, and that's something else we're going to have to look for. So another question is, how are households doing? And what you're going to see is generally they're doing better, and particularly if you own assets. And this also is playing into one of the big dynamics we're seeing right now in the US economy, which is just really strong demand, particularly for goods. Household balance sheets are in really good shape. And this means that people have liquidity. I mean, they have money to burn, and they're interested in going out and buying things. And perhaps this is even making them willing to buy things at higher prices than they've faced in the past. So the first indicator of this is the personal savings rate. So as you can see, when COVID hit, the personal savings rate in the United States just exploded. And then it's been on this sort of roller coaster ride, but it's still at a higher level than historically it's been, at least for the last 5 to 10 years. And that's suggesting, again, households have put money aside. They have money to buy things. They're feeling pretty good about their circumstances. Now, you combine this with the run that we've had in the stock market. And again, if you think you're an asset owner and you have stocks, you've also seen your portfolio really swell during this period of time. And not surprisingly, when you put high house prices plus stock market plus higher savings rates together, what you're seeing is household net worth really surge to record levels for the US economy. And again, all this household wealth can be translated into stronger demand for goods and services. So let's turn to what's becoming probably the biggest headwind to the economy, and that's inflation and what's occurring within supply chains. So the first thing to consider is inflationary pressures clearly reflect what's happening in the supply chains. These bottlenecks are causing people to have to bid for everything from delivery services to basic supplies, and all this drives up prices across the board. You also have seen the supply chains impacted by things like natural disasters. There was the Texas freeze, obviously the beginning of this year. That affected everything from plastics to energy. Then you saw the hurricanes come in. They also affected energy disproportionately. And all of this is also being compounded by extreme labor shortages really across almost every category of work of industries that you're looking at this point. Again, if you talk to most economists, they still suggest these pressures are transitory, but the duration appears to be stretching out much longer than originally anticipated. And really, most economists now are suggesting there won't be till mid next year until we start to see sort of these supply chains kind of right themselves. And then we get this sort of reduction in sort of the pressures that are causing some of this inflationary troubles that we're seeing. So this figures show both the PCE and the CPI-U for the U.S. economy. And the red line is the consumer price index for all urban consumers. As you can see, it always traditionally runs hotter than the Fed's preferred index, which is the PCE. But as you can see, both really took off significantly coming out of February. So after this very long period of time in which inflation on either indicator was running below 2%, which is below, again, what the Fed's target is, now all of a sudden it's broken out to these much higher levels. And while it's shown some plateauing, again, it's plateauing at a very high level. What you can also see is there is some indication, at least among, sort of consumers and sort of business people, that the inflationary expectations are definitely hotter in the short term than they are in the long term. So this is the New York Fed survey of consumer expectations. And what you can see is if you look at the July survey, as you can see for the 1 year ahead, the expectation was for inflation to be running at 2.92%. But as you can see by August of 2021, that had blown up to almost 5%. So really rapid acceleration in what the expectation was for inflation. But if we look at the 5 year ahead, you see a much more kind of sanguine sort of outlook. So it only goes from 3 to 3.16%. Now, 3% is still significantly above the Fed's 2% target. But as you can see, there's not this expectation that the same level of acceleration that was projected for the 1 year is being suggested for the 5 year ahead. And finally, let's turn to supply chain and and how that's affecting prices. The first panel shows you PPI container prices and freight transportation prices. As you can see, this is almost like a straight line up in 2021. Frankly, it's almost impossible to find a container. It's almost impossible to find a ship to put it on. And all these things are bidding prices up to sort of record levels. Interestingly enough, you would expect the same to be shown in railroad traffic volumes, but the decline actually in traffic volumes is reflecting just how disrupted the supply chain is, because these containers aren't able to make it into port, be offloaded and put onto railroad as they normally would. So you again have had this sort of sense in which once that's restored, you'd expect these traffic volumes to go way up in terms of railroads. You can also see this again in basic input prices. So, I mean, steel prices on both of these two sort of basic commodities, hot rolled and cold rolled steel, have just taken off since July of 2020. And if you think of steel being a basic input to so many products, whether it's household appliances, cars, building structures, all sorts of things. I mean, these are just extraordinary prices to have to absorb. And clearly some of these are being passed on at this point. The other thing that everybody has heard a lot about and has affected the auto industry has been the unavailability of chips. And as you can see, microchip ordering cycle has just gone sort of haywire over this period of time. Even now today, if you're building a truck and you're ordering chips for that truck or for that car, as you can see, it's a long wait time before you're going to see those chips, basically 22 weeks at this point. And that's what's leading to so much of the auto production either having to shut down or cars being produced and then parked waiting for the chips to come in to be able to complete them and then send them on to consumers. So the last thing I wanted to touch on is just a few quick indicators for Illinois, Indiana, Wisconsin, the three states in this regional alliance. And I want to look at employment and consumer spending patterns. And you'll see a little bit of a variation in terms of the three states. Generally speaking, Illinois is going to be lagging a bit. It has recovered slower coming out of the pandemic than Indiana and Wisconsin. And you're going to see sort of that play out in the numbers I'm about to show you. So these figures come from Opportunity Insight. This is a very interesting project that was put together by Raj Chetty at Harvard and a number of his colleagues. And what it does is it uses real-time data to show how the economy is performing. And again, what this highlights really is the change in employment, and it shows you just how different this experience has been based on what kind of jobs you're in. So high wage employment, as you can see, has actually shown an increase, all right, in terms of the availability. The change in employment has increased by about 4.3%. As you can see, middle wage jobs are essentially flat, but it's low wage jobs that continue to show the decline. So, this was only through August 1st, but as you can see, it's a 40.3% decline in low wage jobs in Illinois. So again, the recovery is disproportionately in high wage jobs, not really in low wage jobs. So again, you're getting this very K-shaped pattern in terms of who's recovering in terms of the employment picture in Illinois. And the same patterns are going to show up in the other two states, but in a slightly different way. So as you can see, India has generally done stronger in terms of its recovery from the pandemic. And so you can see high wage jobs in Indiana are up significantly more than they were in Illinois, up 14.7%. Middle wage jobs are also up 9.8%, so pretty healthy recovery there. And low wage jobs, again, while they're down, are down only 18% versus the 40% we were seeing in Illinois. So again, a different pattern in terms of how Indiana has responded. Wisconsin, again, sort of in the middle. High wage jobs also up significantly above where Illinois was. Middle wage are also up, and low wage jobs are down 24.7%. Again, not as bad as Illinois' experience, but not as good as Indiana's experience. And the last thing I want to talk about is consumer spending. And again, I'm going to look at all three states to show you the pattern. As you can see, once consumers were sort of unleashed, what they particularly did was go out and spend on goods. As you can see, total spending in Illinois is up almost 21% since the pandemic began, with retail up particularly strongly, up 24%. But as you can see, entertainment and recreation is still languishing. It's still down below its pre-pandemic level. It's also extremely choppy and reflects, again, sort of when the sort of pandemic waves hit, because people then tend to stay home. They don't, go out to entertainment and recreational activities. If you look at Indiana, again, you're going to see a slightly slower in terms of recovery in terms of spending at 19.9%. Retail, I don't exactly know what's going on with the pattern in retail in Indiana, why it suddenly declined so rapidly to, down 2.4%, but again, essentially flat. And entertainment and recreation, as you can see, down still a sharp 11.7%. So again, what industry you're in matters a lot in terms of how you've been doing, both during the pandemic and now in recovery. And finally, for Wisconsin, Wisconsin retail's up a very strong 26.2%. Total spending's up a strong 17.3%. And here, in this case, entertainment and recreation's actually up a bit. Wisconsin probably benefited some during the summer, in particular, from having sort of better vacation opportunities. So as people wanted to go, rent a cabin or be on a lake or something like that, Wisconsin got some boost from that, having that kind of amenity. So I just want to conclude for suggesting some ideas for how the region might position itself for a post-COVID world. And again, I'd say a lot of these are kind of hypotheses, kind of speculative, but I think there's some things for us to think about over the next several years. So the first is manufacturing. One of the principal advantages that all three states have is that they have a disproportionate manufacturing sector relative to the US for the most part. And so one of the things you can think about is we've heard from manufacturers consistently that they want more resilience brought into their supply chain. And many are describing that as essentially bringing the supply chain closer to them. So more domestic suppliers, again, probably within 500 miles of where they're located. And this could be an opportunity, okay? So to bring that supply chain closer to where our final manufacturers are, that could benefit the region. Another is that clearly distribution and logistics is going to be critical in any way you think about the future economy. And this is another area where the Midwest has extreme strength. We have a better rail system in terms of just its sheer volume that can occur. We've built out a distribution and logistics system that is better than many parts of the country. And again, if we continue to work on that, that could be a strength going forward. A challenge that clearly all the states are going to face is, what do we do with our downtowns? If you think of what drove a lot of economic growth during much of the 2000s, it was this sort of strength of downtown central business cores. And now, again, with maybe not as many workers returning to these downtowns, we may have to think about how do we repurpose or reposition downtowns to sort of pivot to kind of a new economic model where maybe not as many downtown workers are there on a daily basis. Another thing that, again, I can't emphasize enough is we still have an advantage because relative to particularly East and West Coast locations, our cost of living is significantly lower, even in major cities like Chicago. So I've always thought that I wanted to develop something that I would consider to be like a cost of living, a cost adjusted quality of life index for the region. And I think if you did this, what you'd find is this cost adjusted quality of life is really high relative to other places. And that, again, is something we could capitalize on. We also have an excellent higher education infrastructure, between the Big Ten, the many other fine institutions, including also the community college system. We can leverage that education infrastructure to continue to build on the region's advantages. Our biggest challenge is still going to be demographics and weather. We're aging relative to the rest of the country. We don't have the weather that the South and the West obviously has, and there's not a lot we can do about that at this point. And then the one thing I also say is sort of a cautionary tale that we're hearing is that part of this notion that you can sort of hire talent anywhere is showing up in anecdotal stories we're hearing, which is East and West Coast firms now are coming in to poach relatively cheap Midwest talent. So what they're finding is particularly in IT and finance jobs, in many cases, if they say to these workers, you can stay exactly where you are, and we can pay you more than you can get paid by your current employer, but we're going to sort of take advantage of the fact that you're highly skilled, highly talented, but you're also cheap relative to what we normally face in our local labor markets. And so there's some concern that some of our best talent may be getting poached at this point, and maybe we should develop some sort of strategy to think about those things. So thank you for your time and attention. And I think this is going to be a great program, and I'm looking forward to hearing more about it.
Thank you very much, Rick. I appreciate that overview. I can certainly say as a person whose education is in economics, that was very thorough. I love the graphs, easy to understand, and it certainly gave us kind of the overview for the rest of the presentations. As you know, we're working tomorrow on future of the workplace and the workforce. And on Wednesday, we'll be manufacturing. Thursday, we're going to hear from our leaders, from both elected and people in public policy about kind of the state of the region during and after the pandemic. And then Friday, we'll talk about infrastructure. So this was the perfect setup. It was exactly what we needed. And I really appreciate your participation, Rick. Thank you very much.